Good morning, everyone. Thanks for joining us today. Welcome to the Toys R Us Investor Conference Call. We've got all attendees now in listen-only mode. On the call today, we've got Toys R Us CEO and MD Louis Mattoni and CFO Wei Si. I'll pass you across in a moment to Louis to kick off our discussion of the company's full-year results. We'll have a presentation from Louis and Wei today, followed by Q&A. If you would like to ask a question during the call, please type it into the Q&A panel within the Zoom app. Alternatively, anybody who has dialed in using their phone can email any questions to tim@nwrcommunications.com.au and we can address them that way. So to kick things off, I'll hand over now to Toys R Us CEO and MD Louis Mattoni. Go ahead, Louis.
Thanks, Tim, and good morning to everyone, and thank you for joining us today for Investor webinar. I'd like to go over a few milestones and developments of the company. And since the acquisition of Toys R Us and the Hobby Warehouse Group in December 2020, there's been quite a lot of transformation in the business. And it's good to go back and revisit some of that before we go through our presentation today. So firstly, in the first half of 2021, we really worked to refocus the business from a toy distribution business into a direct consumer model. Then through 2021, we installed and commissioned a state-of-the-art autonomous mobile robot facility, and that commissioning was in August 2021. And that change was also accompanied with adoption of a new warehouse management system across all of the operations of the business, and including direct-to-consumer and B2B as well. A few other things that we achieved during the year was the commissioning and really entering into quite a significant agreement on a new DC in Clayton, Victoria, in the first half or toward the end of the first half of 2021 calendar year. And that was really to set the company up for its future growth. Following that, quite a significant milestone for the business was that we secured a long-term exclusive license agreement to operate the Toys R Us and Babies R Us brands in the United Kingdom. And this is really an exceptionally significant milestone for the business, for the company, and achieved very early in its development, in just over 12 months of the acquisition by Fantastic of the group, and one that I personally have stated in previous discussions and announcements that it will eventually account for up to 75% of our business, being such a significant market, and the largest in Europe and fourth largest globally. And we'll talk about some of that in following slides as well. Associated with that quite significant achievement was really several months ago, we secured a partnership agreement with Amethyst Group. And that was really for us to establish a capital light, scalable logistics operation in Midlands, UK. So it meant that we could establish our team, our executive team, in very early 2021, and have a very capital light method of addressing the logistics as we scale through the UK, not only through this peak period, which is just ahead of us, but through the next 24 months following that. From February through to present, we have really been very busy with quite a few challenges and tasks, starting with upgrading of our accounting systems, our ERP systems, and our websites, to provide the business with the ability to grow for those future needs that I've just mentioned. These changes really enable us to handle significantly higher volumes of transactions, multiple country tenants, Australia and UK, multiple currencies, multiple tax zones. And all of that really was necessary because it means that we can achieve those transactions with much less human intervention on very simple, mundane tasks. The good news is that last week we soft launched into the UK, with our Toys R Us and Babies R Us separate websites. And the soft launch was really to test our systems and verify those processes and technical mechanisms for order placements, or from order placement right through to dispatch. So it was quite significant in that it meshes together all of our systems, including our ERP, our websites, and all of the changes we've made there, back into our accounting systems, reconciliations of payments from our shoppers, back over to our warehouse partner in the UK, and then back into that ERP system for tracking updates and other shopper communications. So that was quite a successful soft launch. Following some further adjustments, we really expect to launch officially over the coming days. So most disruptions to our business and revenue in late last year and early this year, some of those that I've mentioned here in particular, and the investment in the future of Toys R Us, in particular, a cut-off and partial closure of the business was necessary to migrate the warehouse facilities and robotics in August 2020. And 21, sorry, and a cut-off and partial closure at half-year end from February through to present. Those were really necessary to migrate the administrative support systems. So these disruption or disruptive periods have, however, coupled with some unexpected challenging trading conditions that were not anticipated in late 2020. They've led to some lower than expected revenue levels, particularly in the second financial year. Some of that is really as a result of sequential delays to our commencement in the UK. Originally, we were anticipating commencing in the UK around about June or July this year, but through a number of equipment delays and other sequential delays, of course, that soft launch has just occurred in the last week or so. However, the Australian business is still at a very early stage in its development. We hold a very small but growing market share, and the business trajectory will inevitably experience those sorts of shorter-term oscillations due to market conditions or developmental factors. We've had, I think, a total of 2 to 3 partial close downs in trading, which did affect us through that first and second half. I think really the only other thing that I'd like to say before starting with our presentation or other facets of our trading highlights is that we're really analysing our trading data carefully as we grow, focusing increasingly on the awareness of Toys R Us and Babies R Us brands in Australia and soon in the UK, and really focusing on working to minimise further partial closures or disruptions which have affected us in that performance over the last 12 months. So I would like to pass over to Wei Si, our Financial Officer, who will provide an overview of the company's financial results.
Thank you, Lewis. Good morning, everyone. It's my pleasure to present to you some of the key highlights on the FY22 full-year results for Toys R Us ANZ Limited. Looking at the slide on 3 in the presentation, some of the key metrics. So the continuing operation of the business achieved 37.9 million sales revenue during the financial year, which is an increase of about 16 million, or worth 74% on last year. Of that, the B2C segment achieved 26 million, which represented 98% year-on-year growth. The B2B segment hit more than 11 million sales, which represents 28% growth year-on-year. In terms of gross margin generated from the continuing operation for the full year, it was about 8 million, which is an increase of 3.9 million, or 93% increase on last year. Moving down to the P&L, the Ebitda loss from the continuing operation was 9.1 million against an Ebitda loss of 4.4 in the prior year. This is a result of increased operational expenditure and investment, particularly in marketing, working capital, and inventory to support the growing strategy as Lewis mentioned earlier. Breaking down in terms of some of the key operating expenses, we look at warehouse and distribution. Over the year, total expenditure increased about 1.4 million around that area, which is mainly due to one, increase in freight expenses as a result of higher sales volume from the continuing operation. In addition, the general increase in fuel prices, which represent about 800,000 additional impact to the P&L. The second factor is also higher rent expenditure worth about 250K, and that reflects the full 12 months of rent for the new Dandenong warehouse, which Lewis mentioned. The lease started around December 2020. The third factor driving higher warehouse and distribution expense is higher associated warehousing cost to support the increased sales activities during the full financial year. Total warehouse and distribution expense for the group only increased about 190K year on year when we look at the full group, so both continuing and discontinued operations. The next major expense category is marketing and selling expenses. So overall, for the continuing operation, it increased about 4.4 million compared to last year. Of that, 2.2 million relates to royalty, which the company pays to Truck or WHP Global for the exclusive Toys R Us brand license, both Australia and the UK. I'd like to highlight that in FY21, the royalty expenses was recorded as part of cost of goods sold, but in FY2022, as part of the audit recommendation, this cost should be reclassified under marketing because it's associated to maintaining the exclusive brand and license for the Toys R Us. So if we were to make an adjustment to FY21 COGS, stripping away about 1.1 million of royalty from last year's cost of goods sold, the gross margin for FY21 will increase from 90% to approximately 23%, in comparison to FY22 of 21%. Moving along, going back to the marketing and selling expenses. So aside from royalty expenses, online marketing expenditure also increased by about 1.9 million in FY22. And this mainly relates to increased Google advertised clicks. The total expenditure was 2.7 million, represents 7% on sales, versus last year of 900K, which was 4% on sales. In terms of selling expenses, it comprises of mainly merchant fees, which was 720K versus last year of 360K, an increase of $360,000. And this is again driven by increased B2C sales volume. Moving along to the administration expenses. In this area, the business managed to achieve a 200K decrease year on year within the continuing operations, but reduced about 1.5 million year on year for the group. And this mainly reflects the wind down of the legacy Fantastic business and its foreign subsidiary operations during the financial year. The last major expense category is staff cost. Overall, it increased by 2.7 million, predominantly due to 2.1 million of which costs in FY21 are now being disclosed as discontinued operations, as they are related to the Fantastic business. So if we were to ignore that anomaly, overall the business experienced about 600K in increase in in staff expenses, and that's mainly due to addition of the UK team in FY22, along with increase in warehousing, casual and agency staff to support the busy period during the year. Moving on to net loss after tax. So the net loss after tax from continuing operations was approximately 24.8 million versus a net loss after tax of 5.1 million in the prior year. FY22 NPAT includes a one-off goodwill impairment of 14.5 million relating to the B2C segment. In addition to this one-off adjustment, depreciation expense increased by approximately 500K as a result of investment in CapEx, including the state-of-the-art AMR robotic picking system in mid-FY22. Amortization expense on customer database acquired also increased by 200K, reflecting a full 12-month impact. That's pretty much the key highlight for the profit and loss. If we move to the balance sheet, the two main areas I want to sort of highlight is that cash and equivalent as at reporting date of 31 July 2022 was sitting at 12.5 million, which is an increase of 5.8 million on last year. This was supported by the long-term loan facility, which Lewis mentioned in his part of the presentation. So towards end of July, the company secured a 50 million loan facility, of which 10 million was accessed to support the UK launch and the capital requirement of other initiatives in the ANZ operation for the short and medium term. The other area on the balance sheet that I'd like to highlight is inventory. It was reported at 9.8 mil, which is an increase of 4.8 on last year. This is due to the fact that the business is currently preparing for the upcoming busy season in both Australia and the UK markets. The reason for the higher than normal inventory holding is to avoid similar disruption and delay of shipment experienced in the same time last year. I think we'll hold off on answering the question towards the end. So for now, I'll pass the mic back to our CEO and Managing Director, Lewis and Tony, who will take you through some of the key operational highlights and achievements during the year. Over to you, Lewis.
Okay, thanks, Wayne. And one of the things that I would highlight there as well is that we haven't worked to optimize our balance sheet during this period for some of those reasons that Wayne has mentioned, i.e. because of previous supply disruptions and ensuring that we do have adequate supply, in particular for the final quarter of the calendar year. That's really one thing that has been quite important to the business and the executive planning, but also the investment that we're putting into the UK. So our license commenced in the UK in December 2021, and from that period through to present, we've been investing in the purchasing of inventory, and there are some figures here that we can present on the type of inventory that has been brought in to support the UK. Obviously, without any revenue sales, we've been inducting a lot of that inventory into the new facilities in Warwickshire, UK, through our Amethyst logistics partner. So really just recapping a couple of our key achievements. We've talked about some of these in the preamble. Really the largest recent highlight has really been the soft launch of our UK website, which we believe is really set to stoke organic growth in the business and will be quite significant after a short period of time. And lastly, of course, the warehouse upgrade nearing completion in the next couple of months. The DC preparation, we're set to move the majority of our bulk picking operations and offices and our colleagues in coming weeks. So they're amongst the key achievements and some of the others there that I've already talked about earlier. So just recapping a few of the elements that we've talked about in past updates. We're at around about 185, in broad terms, 185 vendors, 685 brands, now over 20,000 products. And that's really across all of the retail pillars, Toys R Us, Babies Us and Hobby Warehouse. 188,000 active customers. And I'll give a little bit more detail on this in the next couple of slides. Higher AOVs, trending up towards the 130 plus mark, and still quite favourable average cost of customer acquisition that we've been experiencing. So just firstly, in terms of the the customers, active customers, we have a very strong first half, and through 2021 calendar year, it was extremely strong. There was still some COVID concerns and concerns in terms of the availability and delivery disruptions, which were quite prevalent through that period of time, particularly in that Q1, the financial FY22. So we did see quite a rapid incline or increase in our total active B2C e-commerce customers across the business. This declined in the first half because of that trend and the fairly strong period that we experienced through the first half. And just on AOVs, so we have seen AOVs trending fairly steadily. It's been increasing on a trending basis over the past 24 months. And these are really due to increases in the percentage of returning customers, which in a couple of periods in the last half year, a financial half year, have exceeded 20. And I think it was up to around about 23% during certain periods of the second half. Now, that is offset by lower or more challenging conditions that we faced, and not just, I should say, in our B2C. When we see our B2B customers experiencing similar challenges, it's not just the toy market, it's other markets that we get data up on. And but we did manage to increase the AOVs, not only through that increased loyalty and percentage of returning customers, but also through a different product mix and ranging, which continued to contribute to that trend. And just a couple more bits of information specific to Toys R Us active customers versus the previous corresponding period. A reasonable increase between the two half-year periods, and it was actually good to see that we did increase conversion rates on our click ads. So the click ad conversion rates, there's still quite reasonable costs that we're experiencing with our ads, are still providing us with a reasonable return on investment on those platforms. B2B segment, as we touched on earlier, has performed quite well. We did see the industry affected by some of the economic factors and general market trading factors that I mentioned earlier, but still performing quite strongly in terms of providing a positive Ebitda contribution. Just want to touch again and really reiterate some of the background with the UK. It is really an excellent market for us to be entering into, and this is why I say that we believe it is really one of the biggest milestones for the company that we achieved in late 2021. It's the most advanced e-commerce market in Europe. It is forecasted to increase in one in three toy sales, of all retail sales by 2025 will be consummated online. It's ranked third worldwide by the number of online shoppers per capita, and ranked fourth worldwide by B2C revenue. The addressable market, some of the figures are in this presentation. We've talked about those before. And of course, Toys R Us really does remain a legendary and much loved brand in the UK. So just recently, Toys R Us UK has soft launched with around 4,500 toy items. Us also launched with around 1,300 items. This is an incredible achievement, given that that was well in excess of what we launched with in Australia. And already we're up to about 178 vendors, which is comparable already to the number of vendors that we have in Australia. All of the arrangements with our delivery carriers were completed in the last 4 or 5 months, and confirming again through the soft launch that we have all of those processes flowing through and being tested. And what we're looking at is rolling out additional payment methods and other technical details, which are occurring as we speak, and hopefully over the next few days we move into the official launch. There's a number of introductory offers that I refer to there, and they're visible on the site as well. So that really concludes our presentation to the investors. I'd like to hand back to Tim, who's hopefully available there to help coordinate any questions that you might have.
Yeah, very much so, Louis. Thank you, and thank you, Wei, as well. Great presentation. Thank you to all attendees. We've had some interesting questions come in, so certainly encourage all attendees, if you've got questions for management, please do log them into the Q&A panel, and we'll hop straight into them. So first question that's come in, Louis, sort of zooming back to have more of an industry view, the comment's been made that overnight Hasbro in the US put out a rather bearish view of their Q3 revenue trajectory and guidance. The question is, what have you seen in the toy segment in Australia in the August to September period?
So what we saw was the Australian market was affected through late 2021 and early 2023. There are global variations. So within Europe and the UK, the toy market experienced a delayed onset of reductions. We are hearing also that a lot of this is really a result of the retailers experiencing distress, whether it's inventory distress in Europe, and some inventory distress partially in Australia, but probably not to the same extent. And so with some of that, we're working very carefully with all of the large partners from Lego, Mattel, Hasbro, MGA, Spin Master, and so forth. We are drawing on their domestic supply, their domestic stock in the UK, and we have heard the same data in that much of the orders have been cancelled or reduced or even returned back to Hasbro and other vendors. Now we're entering a very, I think, opportune time to take advantage of some of these potential events. And Wei, I don't know if you've got the breakdown of our inventory between Australia and the UK, but we are entering the UK with a very, very low level of inventory compared to the size of the market. And there may be some opportunities for us to work together with those vendors, such as Hasbro and others, to maybe obtain better pricing, clearance items that will assist us to increase our margins and have some sort of competitive advantage as we're moving into that market. And of course, in this market, we're working from zero through to a number in that market, which is going to be quite significant for us in terms of the total size of our business. And so going from 0 to 0.2, 0.4, 0.5% of market share is really quite rational. We're not saying we want 10 or 20% market share to achieve our medium-term aspirations. We've stated those aspirations at 5% over the medium term, but it just really takes 0.5% of market share and working together with those vendor partners. So we're nowhere near as static. We're right at the beginning. So we see those as positive opportunities.
Very good. Thanks, Louis. Next question is that with the new distribution centre in Clayton and the expansion into the UK, the comments made that the operating expense lines will increase significantly year on year in FY22, particularly in marketing and selling. The question is, do we expect to see another significant step up in staffing, warehousing and marketing cost lines in FY23? Or has the bulk of the heavy lifting been done in FY22? And would FY23 then be incremental rather than a significant increase on those lines?
I think this really comes back to one of the points that Wei detailed earlier in terms of our marketing and selling expenses. It's our actual marketing percentage as a proportion of our revenue is not 15%. It's a much smaller percentage. There really is a breakdown of the figures within that. We will be carefully increasing our marketing expenses and looking at our data as we grow within the UK and also as we ramp up further in Australia. So in terms of staffing costs, we have a total of 8 staff in the UK. We don't have a team of 50 or 100 in the UK. And the way that we've structured our logistics to be a capital light, scalable solution, if we as we scale, then those costs will scale with the revenue and the activity, order activity as appropriate. And that's something that the management team will be controlling quite carefully. Of course, there's been a lot of investment in marketing. So we've gone through quite a lot of marketing preparation. We had to design the website for the UK. We've had almost 9-10 months of a lot of that marketing investment, which are in those numbers that you see with zero revenue. And so when you look at those percentages, you may see distorted percentages and figures. But we have taken the view that we need to invest in those areas to lay the foundations for a much stronger growth trajectory of the business going forward.
Thanks, Louis. Next question is on the improvement in average order value. So I know you touched on this in an earlier slide, Louis. I think you called out that it was related to growth in repeat customers. But the comment that has been made is congrats on the very strong improvement in average order value to 133.50. Keen to know what's driving that. For example, can you put it down to price increases, greater basket sizes in lockdown, promo periods, mix shift, higher ASP products, or anything else?
Look, the answer is not to dodge the question, but a whole mixture of the above. It's really about a mix of the products that we're bringing in and making sure that we have higher AOVs, particularly as we're starting to see the Babies R Us business growing. We do see some higher AOVs in there. I've got to say there's a lot more upside potential here because we haven't fully optimized our bundling of products into orders and suggestive selling. We're still, we've been very focused on the development of the UK, which required all of those technical aspects with multi-tax, multi-currency, multi-tenant, etc. We've been focused on those, but there's a great deal more that we can do to get the AOVs up even further. So it's really a mixture of all of those, and returning customers tend to spend more. And as the business develops, we will increase those AOVs further because, they've experienced our service, they're coming back, they're more confident to purchase more. So there's a whole range of elements that feed into that AOV.
Makes sense, Louis. Thank you. We've had a few questions on cost of acquisition, so I'll bundle them together. The comments have been made that the cost to acquire customers increased in the second half versus the first, in line with other e-commerce providers. The question that's been asked for you to talk a bit about what you're seeing in the cost to acquire customers and how investors should think about CAC going forward into the first half of 23. And I guess as a sidebar to that, how should we view the CAC for the UK once it starts contributing? Would it be higher or lower than Australia's recent $12.45?
Yeah, well, firstly, on the CAC in the UK, we'll be controlling that fairly carefully. It is a lever that we have. I mean, we could, in the past, we had our CAC as low as just over $5. We do need to have, we do want to invest in a reasonable CAC. $12.45 is still much lower compared to other e-commerce players. I think I've mentioned in the past that I would feel comfortable going up to $15 to $17, provided that we are acquiring new customers. So we saw most of that increase in the fourth quarter, but we have seen a pullback in that. So there has been industry-wide pressure on advertising where everyone was really pushing through the same conditions that we were experiencing, but we have seen that ease off. The way that we, can kind of forecast, it's just a forecast. We can't really put a hand on a heart and say this is precisely what we think will happen, but we have seen the CAC come back in the last couple of months. Certainly through the final quarter of, or the first half of FY23, we expect the CAC to fall, and our margins to improve through that period of time. So there's a range of elements that feed into the equation on the cost of customer acquisition, through the product mix, the returning customers, the strategy on the product marketing, and probably 2 or 3 other elements that we will be carefully monitoring as we work through these next few months.
Yeah, a lot of levers under your control, which is good. And still on the cost side of things, the question's been asked, how have you seen the movement in costs of the toys? Are you seeing manufacturers increase pricing much? And has the recent easing of resin and shipping helped with your gross margins looking into the year ahead?
Yeah, so there have been some cost increases in the toy space. One of the reasons our inventory levels are a little higher than usual was that we took advantage of pre-price increases to stock up on key items, in particular popular brands such as Lego, Hasbro, and Mattel and Spin Master and others, ensuring that we did escape some of those increases, and we're starting to see some of that flow through a little in increased GPs. And what we feel and what we're expecting is that through the final calendar quarter, that some of those margins will increase still further, not only because it's a peak period, and that we'll be focusing on trying to push our marketing and our awareness of products with higher margins, but also that a lot of the lag in certain inventory items, that there's been quite a lot of competition in depressing margins, that we're expecting those to really change through these next 2-3 months as well.
Yep, thank you. Looking to customer activity, the question's been asked, are you able to provide some more colour on the very minor decline in active customers from the first half to the second half of FY22? Is it related to major sales events which drove greater traction in the prior period, for example, Black Friday or Christmas or other things?
I think if you look at the overall trend, and these are lumpy figures, through the tail end of the first half, 2021, in particular the final quarter, there was really still a great deal of activity around delivery disruptions and concerns around delivery disruptions. with Australia Post and other carriers. And so we did have quite an increase in those customers through into the second half, FY22 that you see here. We had a couple of disruptions where we partially closed the doors to business. And on top of that, some of the generic economic factors and challenging trading conditions combined with that. If we hadn't have had some of those, then we would have, potentially a similar growth that we experienced from H1 financial 21 into H2 financial 20. The first half will always be fairly significantly higher. And so, yeah, we expect that our next first half for FY23 to be, back up in terms of the total B2C e-commerce customers.
Good stuff. Thanks, Louis. Just back to average order values and the product mix. The comment's been made so far that sales have been dominated by toy products. And the question is that as more baby products come into the mix, should we expect the AOV to go up or down, given the average values of the SKUs on the baby side?
Yeah, so generally speaking, and this can fluctuate, so it's really difficult to say definitively, but the AOVs should increase, and we are seeing gradual increases month on month. Now with the Babies R Us brand. So, with strollers and many other products that we sell through Babies R Us, starting to increase in their contribution to the overall business, that will start to impact on the total AOVs across the business. But what's important for me to point out here is that these AOVs are solely Toys R Us AOVs. So it really is through the product mix and the returning customers that these results have been achieved. As we start to look through the business as a whole, we in future updates we'll provide some of this data on a total business, and maybe even a breakdown on some of those sub-segments, such as Babies R Us, where you can see what those contributions are. But these figures that you see are really focused on Toys R Us order values, not taking into account hobby or toy, hobby or baby.
Yep, sounds good. Just looking to the balance sheet, the question's been asked, can we explain the $14 million impairment of assets and comment on why the impairment was so large?
Yep, Tim, I can address that. So the goodwill was a total about 26 million for the B2C segment. And this was arise from the reverse acquisition of the Fantastic and Hobby Warehouse Group. During the FY22, there was a trigger for impairment because we had to revise our forecast in light of the challenges, price pressure, as well as rising costs such as freight, marketing, all the above. So with all those factors coming into consideration, we had to revise our forecast to a more sort of close to reality and less sort of aggressive target for a run rate of 6 to 7 years term. Plus the model that we use, recommended by auditors, is very sensitive, and some of the metrics that they advised to use was on the very high end of the spectrum, such as a discount rate of 14 to 15%, when we were looking at a more realistic rate of say 11 or 12%. But in the end, we agreed to the spectrum, knowing that we want to report a reasonable number. Hence why, looking at all the valuation of the above, we had to there was not enough future net discount cash flow to support the current goodwill value of 26 million. As a result, we had to write off 14.5 for the B2C segment. The B2B segment, on the other hand, is a different story. It continued to make net profit after tax, hence why there was no trigger for impairment on that side. Additionally, I want to add is that, at the time of the goodwill was made, which was in the last financial year, the UK operation was not in the picture, even though it is now, going to be a larger part of the overall Toys R Us group, where management will focus a lot of capital, focus, and strategy onto that part of the business. It will not be factored into the goodwill valuation model because the goodwill occurred and it was generated before UK license was acquired. So that's a key point I want to factor in. Thank you.
Yeah, no worries. Thank you, Wade. Now, we've had a few questions come in on the outlook for revenue, cash flow and profitability. So I'll sort of group these together and Louis, maybe you can provide your perspective on some of these things in aggregate. Looking to the UK, the question's been asked, can we talk about the monthly revenue run rate that the company needs for EBITDA break even in the UK business?
Yeah, I think it will be difficult, Tim, for us to provide some of this data. It's not public, and I think as we start to get some data over the coming months, what we'll try to do is provide some of that information in business updates. We do anticipate as we follow the official launch in the UK and start to collect data that we can convey to the market, we'll start to convey these sorts of measures as well.
Yeah, thank you. A few questions on the loan facility, the $15 million facility, which you recently secured, which has $5 million left. The question is, are there any conditions that are required to be met before you're able to draw down on that further $5 million remaining?
So, Wei, either yourself or I could talk to that. My understanding is that there's we could draw down on them tomorrow. We simply have to provide a period of time or a notice period to draw down on that. But there are no specific gates or hurdles that we need to pass to access the additional funds.
That's correct.
Okay.
Yeah.
Thank you. And looking at that facility still, can you comment on what your financing options are going further? Would you look at an increase in the facility, a new facility, or looking at other options, whether it's an equity raising in calendar year 23 or otherwise?
Yeah, there's currently no. I mean, we always keep capital at the forefront of our thinking and our strategy. So we do monitor capital requirements quite carefully going forward. But there's nothing that I can really share in terms of plans or the strategy on what those might be.
Yep, no worries. Well, you've got flexibility, which is good. And so just changing tack quickly, we've just had another question back on the UK business. So can you comment on what the fixed costs in the UK are beyond the 8 employees?
Yeah, so beyond the paid employees, we really have a flexible leasing of space within the 3PL. So within the 3PL, we have, I think it's around about 13,000 feet, a fairly small area to commence with. And as the business grows, we will want more stock, more inventory, and we may obviously look, or we would look to expand that footprint. So we negotiated the costs for the storage of equipment. And the second part of that is, as we also scale up with a number of orders in the UK, we can bring on additional warehouse operators And again, we would scale that as the business scales. There's very little CapEx. I mean, we did have some equipment that we needed to deploy from Australia into the UK due to some of the disruptions in Europe. We managed to reduce some of those disruptions from 3 months to 1 month, but very little CapEx involved. So it's a fairly capital light, OpEx controlled, scalable strategy that we've entered into for the UK.
Yep. And so is it fair to say that the required minimum sales to achieve profitability there is just to cover those 8 or so employees?
Yeah, correct. Plus storage, of course, of the product. But it could be £1 million a month. 1 to 2 million pounds. We would have to come back with some more figures to have confidence to provide those, and can do that potentially as we get started.
Thanks, Louis. Just coming to the end of the questions that have come in from attendees, and thank you all for your engagement. If anyone does have further questions, please do log them into the screen and we can address them now with management. The final question that's come in, Louis, relates to the path to generating positive operating cash flow, noting that you're still on the path to, on a growth, you're still very much in a growth phase, and you're working towards achieving sustainable cash flow break even. Can you comment on your confidence of achieving this milestone with the existing capital base? And further, can you comment on sort of what kind of time frame that achievement might be, that milestone might be achievable within?
Yeah, I think really it all comes back to the investment that we've put in place to scale the business and invest in that scalability. And now our focus is very much on scaling the business through awareness and increasing our revenue. And we have very rational goals of achieving 5% to get to that break-even point and profitable operation. So it's always tricky to provide a specific timeline to what that would be. What we have experienced were closures, but we feel that those closures were unavoidable because they were quite major investments and changes in the business structure. The first ones were the warehouse management systems and ERP systems and robotics, commissioning of the automation robotic systems. And the others were around the ERP, where we closed our business operations. And so they obviously affected our ability to get to the sort of revenue that helps us achieve the break-even point. But our focus is completely on achieving what we believe to be very rational aspirations of the 5% market share, and the break-even point is below those figures. So it's really our focus, our goal, to minimise any further disruptions, particularly through the tail end of this calendar year and early next year, that we will be looking at ways to eliminate the need for partial closures.
Very good. Thanks, Louis, and thank you, Wei, as well. There's plenty to look forward to in FY23 for Toys R Us. So that concludes the questions that have come in for the moment. So on behalf of Toys R Us, I'd really like to thank everyone for tuning in today. We really appreciate all investors joining us and for your continued interest in the company. If you have a question that we didn't get to, please let us know and we can follow up with you offline. And we'll also look to make this video recording of this session available online. Really looking forward to the opportunity to talk to you all again. And Louis, I might pass across to you now for any closing comments.
Yeah, thank you, Tim. I think, again, I just touched on some of the points that I was going to close on. I think really what we have been focused on is building a business for the long term, building the foundations through the first couple of years, that will take the business and put the business in a very sound position over the next 3 to 5 years and beyond. So we've been very much focused on developing it for that long-term success. At the expense is, of course, the disruptions that you introduce when you do make major changes. I think it's very important, though, to see that there are huge opportunities ahead of us, especially securing the UK license ability to operate Toys R Us and Babies R Us in the UK, which should accommodate or become approximately 75% of our overall business revenue. And again, with a very low capital outlay strategy. So we're very much looking forward to the challenges. We're very focused on also the increased awareness of the brand in Australia, in the UK. We see it as an incredible brand that has such a great following. Again, extremely strong in the UK, which is going to be our major market. So we're, I'd like to thank our teams, all of our teams, from our warehouse through to customer service and sales, through all of that work that we've been putting in, setting the company up for that future. Excellent. Thanks very much, Lewin. Thank you, Wei. Thanks to all attendees, and we'll catch up with you again soon. Cheers.
Thank you, everyone.
Yep. Thank you.